Good morning, Port St. Lucie. Welcome back to another episode of PSL Daily Download, your first stop to all things real estate. First of all, welcome back to the channel. If you haven't noticed, I've been out for a little bit. I've been like Eminem recently. I'm in the lab. But again, I appreciate you joining me this morning. There's a lot to talk about in the industry, a lot to talk about in the market right over here, you'll see. And we're going to dive right in and see how all of this is affecting rates, how it's affecting the real estate market, and potentially how it may affect it down the road. So we'll jump into that in a minute. But before we do, again, my name is Jaime with Port St. Lucie Mortgage Brokers. Today is August 2nd. Happy Friday. Um, and again, welcome back to the show. So let's dive right in because there's a lot to talk about. So, as we can see in the headline, actually, let me increase that screen right there. All right, here we go. As we can see right over here, breaking news, the market sell-off intensifies. So we are now currently down over 900 points on the Dow, 510 points on the Nasdaq, and over 136 points on the S&P. A lot of red and not, and we got some green down here, but definitely not where we wanted on the VIX. So on previous videos, I've kind of touched on this. Let me again say, I'm not a financial advisor. I'm not, a market expert, right? But these are little things that I follow just to kind of keep a tab on it because it does affect our industry, right, in the real estate market. So I'm going to touch on those. So there's a lot of volatility. For those that don't know, the Fed came out on Wednesday and they announced no change to the federal funds rate, which is the overnight trading rate that they do, or the cost of the funds. So they did not change that, meaning that they were kind of holding off on lowering interest rates to at least September, which gives them 2 months to gather more information. And some of the information came in just yesterday and today. So we'll kind of touch on that, but it'll give them time to maybe absorb this information, analyze it, and see if it's appropriate to lower the rates, which I'll kind of let the cat out of the bag on my thoughts on that. And my thought is that they are going to lower the rates only because all of this is happening. So, kind of a little context as far as before I jump into these numbers, obviously the rates have been coming up over the last couple of years, or they went up over the last couple of years. Um, and with especially when we got to the top of that high rate hike of that cycle, any bad news in the economy gave the potential for a rate cut. So if something bad in the economy came out, some report, anything like that, um, it kind of the market got it as good news. Like, hey, unemployment increased a little bit. Hey, that's great news, right? Because now the Fed might drop the rates. And they've done that with kind of any indicator that came out. If something negative were to happen in the economy, that's great, right? Because the Fed's going to drop the rates now. So that's been the mindset since the height of the increase, or since it got to the peak, basically, of uh, the interest rate cycle, increase cycle, whatever. So we fast forward all of that to now, and the Fed obviously did not increase the rates a couple days ago, but they indicated that it's definitely on the table for September. So what happens? The market bounces, right? Gets excited, rates are coming, and all of that stuff. So now that they know the rates are coming, the rate, sorry, the decrease in rates, the rate drops, right? Um, Now that story about bad news being good news and vice versa, it kind of changed. Now we're back into a reality of a world where bad news is bad news. Why is it bad news? It's bad news because, let's say, unemployment increases, right? Let's say companies are not profitable. Now, this is actually going to affect these businesses. It's going to really affect the economy, regardless if the Fed drops the rate. Um, and if you look back in history, the deterioration or the speed of deterioration kind of increases, especially compared to the way it's the economy speeds up. So, for instance, when the economy speeds up, it kind of, the rates kind of come up, and the economy kind of comes up like in a staircase, right? Boom, 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 and then obviously the Fed increases the rates accordingly. Boom, 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 boom. But when things deteriorate, they tend to deteriorate instantly, right? And I'm not saying that this is what's happening today, but that's the fear, because now if the economy, if unemployment increases, if the economy really slows down, the fear is that people are going to get caught. These investors are going to get caught, right? Um, and they're not going to be able to sell in time because, right, that decrease in the economy or that increase in unemployment happens pretty quickly. And we could go back in history and look at those charts. And I'm sure I've probably talked about it in the past. So, anyway, again, I'm not an expert in this. There's a thousand other YouTube guys and girls that are definitely a lot better at explaining this and with more accuracy than than my explanation. But again, it's just a general knowledge of what I'm trying to share here, and at least my knowledge of what I know of it. So hopefully you take it as that. Now, fast forward to today, or actually to yesterday. Yesterday, there was some information, some indicators that came out, and it showed the economy was slowing. This morning, the jobs numbers came out, and it did not hit, it missed, meaning that the I think the economies or the economists were expecting like 175,000, and I may be wrong a little bit there, but increase in employment, and we only got about 114,000. um and what happened to unemployment? The unemployment went from, I believe it was either 4.1 or 4.2 to now 4.3, and now it's starting to look like a trend. And if you were to look at it again on the scale, it looks like that unemployment is now starting to kind of bend up. And the fear is again that the deteriorations, the speed of the deterioration goes really quickly, and when it does, it goes up pretty fast. So again, not that it's going to happen, but that's the fear, and that's kind of what I believe this is happening now. In addition to that, the market was overbought, and there's a lot of indicators about that, and I'll kind of throw a little bit of that into the mix. So the Nvidias, the Apples, all Googles, all these companies were overbought. They've been overbought for a long time, but I think with the combination of these factors, and now that the bad news is bad news, right? People are getting out. So I think yesterday we were down on the Dow like 600 points, and like 75 points on the S&P, and the U.S. Treasury yield was down 125-ish, 115, something like that at the close, at the end of the day, or close of the bell, whatever they call it. And we could see that it continued this morning. I gotta get this call, so I'm gonna pause and I'll be right back. So, where I left off, the 10-year yield had been down, um, as the rest of these indexes have been down over the last day or so. The trend continues now. But before I get into how, especially the U.S. 10-year Treasury yield is affecting mortgage rates, I'm going to jump into the VIX over here, because this is the volatility report or index. Sorry. And it kind of, I don't know exactly how it's tracked, but basically, like you would think, if volatility is high, that's not a good thing for the market. If it's low, it's obviously it's a good thing. So I am going to scroll down a little bit, and I want to show kind of where we're at. This is on the short term here. As you can see, it's for the last year, and you can't see the line because guess what happened? It shot up literally over the last day. So it's all the way up here. This is where we've been over the last year as far as volatility. Big jump. Now, let's take this into context here. So I'm going to go back 5 years, right? So now we're going to see it, right? This was the pandemic right over here. boom. Obviously, this is at no level close to that. But we'll see that it actually, the volatility is high. I mean, it's comparable to the summer of 23, which we saw in the indexes fall back then. And also in 2022, we also saw the same thing here. Now, I think this one here was more of it coming down from the pandemic, kind of working its way down. But it's a big jump, and especially a 1 day jump. And again, going back to uh, previous statement I made is that these things kind of happen quickly when they do. Again, nothing that, at least for me, that it's devastating, right? But it definitely impacting the market. So let's go back to the indexes here. So we're going to see where US 10-year Treasury yield, and then after this, we're going to jump into the mortgage rates. So, all right. So this is where it's at. And again, let me actually, you can't see that right there. Right here we go. You could barely see it, but check this out. Straight down. We're down here at 3.817. And again, I'm recording this at 11:28 this morning. All right. So you could see where there was a huge drop, which we're at the lows of last year at this point. If I go 5 years, let me see where we're at. We're still high, but we're at the lows of last compared to last year, or kind of the summer of 23, or previous to that, the November of 22. So it's been over the last few years. It's been obviously we've seen it hit these numbers in the last few years. Prior to that, very low, right? Okay. What how is this affecting the market, the mortgage industry? Let's jump right here and I'm going to tell you how it's I'm going to tell you how this is reflecting and I'm going to tell you kind of what I'm seeing real time. So, as we can see here, and again I am on sorry, and I didn't mention this earlier. This chart was from CNBC's Market Watch that I usually have it on right here, the US market. And now I'm going to Mortgage News Daily's daily rate survey, which is right there. Okay. So sorry I'm jumping around a little bit, but make sure I give credit where it's where I'm getting the information from. All right, so we are so Mortgage News Daily's daily website has a 30-year fixed rate currently at 6.78. Actually, this is as of the last closing date, which was yesterday. And it's now showing or went down 0.02. The 30-year FHA 6.37 and it's 0.03 percent down. So here's what I will tell you from what I'm seeing real time. So I am seeing that the mortgage rates are definitely lower than this. Again, it's going to depend on what the qualifications are, but there. So here's what happens when indexes move really quick. Again, I'm not an expert, but I could tell you generally speaking how this kind of works and what kind of where some lenders may get caught unable to actually provide these rates that you see up here. So the rates are scattered, and I'll tell you why. What's happening is that a lot of these lenders, I guess, when they borrow the money or they take out the money from whatever wholesale or their funds or they borrow the funds, whatever it is that they're doing to get the funds, they borrow it at that rate, right? And they borrow it with points or without points, and that's why sometimes it the best rate is usually with maybe a point, and some lenders a little bit higher or lower. But what's happening is that every lender has a rate sheet. So think about a rate sheet, and let's say it starts at 5% and it goes down to 7. Or actually, let's say because we've been in a higher rate environment, let's say it goes from 6 to 8, right? And then, you're all over here on those rate sheets. What happens is when the rates drop really fast, they still have these rate sheets because that's the money that they borrowed. So the rate might be right at the top of this now, but you're not able to actually pay points or a lot of points to actually buy it down more. Why? Because their chart hasn't updated. They haven't gotten the funds. They haven't updated their rate sheet to include those maybe 4% rates that may be available if you paid a point or two or whatever that number is. And some lenders have. So I'm seeing lenders with very low interest rates, and I'm seeing lenders with not so lower interest rates. Um, and I will say that at my previous employer, where I did work at a company, at one of the biggest banks, um, that was a constant problem, especially during the pandemic. Rates dropped really fast. We were stuck. We could not honor those lower rates because we just didn't have them to give because our rate sheet hadn't updated. It might take days or a couple of weeks for that to actually catch up. And again, it's on a lender by lender basis, whatever, however they price out. But we had a significant drop in rates due to the 10-year treasury yield dropping. So, but now mortgage rates are all kind of messy, to say the least. So how does that affect you as a buyer, as a seller, right? As a realtor? So the first thing I'm gonna recommend is, if you work with a lender, find out what that pricing is, especially if you're about to lock in or you're trying to get a price rate, because what happens is this: you might get caught that you priced out that you were gonna lock in a rate, but they don't have those lower rates available. So, where they might cap out at a 6% interest rate, there might be five and a halfs available, right? So you want to make sure that you find a lender that has that. Um, and again, some of the lenders that I work with aren't don't have it, and some of them do. And that's, one of the benefits of working with a mortgage broker is because since we have a different variety of lenders, right, with different types of guidelines and different overlays and different rules. They also come with different rates, obviously, and the ability to offer rates that are available, um, or could be available to buyers, that not all lenders may have available. So hopefully you got all of that information. So the biggest takeaways is that the market is shifting. Um, Again, it can be a temporary move. We saw this last year and 2 years ago. We saw a big correction in the market in the summer of 2022. We also saw a smaller one, but still impactful last year. And again, this may be one of those. When you're going through it, kind of feels a little bit like the end of the world, or that's it, all this all it's gonna crash and all that, and that doesn't exactly mean that, obviously. But the difference in today's world is the, a couple different variables, right? Unemployment is now starting to tick up. There's a steady increase where in none of those other years was that the case. There's also a sum rule. This is something where if unemployment increases, this is something going back decades, I'm assuming, where unemployment increases more than like 0.5%, something like that, from its bottom, it indicates that we're in a recession. Well, guess what? That was triggered today. Again, doesn't mean we're in a recession. I'm just saying that that indicator indicates that. Another thing is the yield inversion, right? So when you compare different uh, bonds, let's say, or notes where a 10-year yield versus a 3-month yield, when you compare those, if the yield is inverted, meaning that the short-term rates are higher than the long-term rates, and then it starts to reinvert, meaning going back to normal. Usually, when that's starting to go back to normal, kind of, I think every time that's happened in the last 60 years, and it's been preceded by a um, by a recession, right? And those yields are now starting to get close to an inverting, right? They're on that. edge, the 2 year, the 10 year 2 month, or 10 year 2 year is starting to reinvert back to normal. Again, not that it has yet, but it's close. And I haven't checked it today. Obviously, I think I don't know if it's inverted, but it was really close as of a couple days ago. So, and again, that's a different, that's another indicator stating that there's something with the economy. So it's just something to keep your eyes on out there for. If you're out buying, I always say there's never a perfect time to buy it. I personally bought not this home where I live currently, but the previous home that I lived at. I bought it at the end of the bubble, at the top of the bubble, and it was a disaster after that. But I ended up winning at the end because I it was a long term investment. I actually kept it for exactly, literally to the same day, 10 years out. It just happened to work out that way, but um, I ended up winning 10 years because it was a long term investment. So this is going to catch a lot of short term people, investors, um, hot, right? But if you're looking to purchase a home to live in for your family, I'm not saying this is the best time. Absolutely not. Because the rates are going to come down. It might be a better time. But there's never a perfect time. And if you're able to find a home that works for your family, that is affordable, that you feel comfortable with the payments, even at its higher point in rates, it might be an opportunity for you to get that home and then obviously look at refinancing down the road. It's not something that I push clients to want to do because I want to make sure it works for them. And there's never a guarantee that there's going to be a point for you to refinance, not only because we don't know if the rates will go down, right? But we also don't know what that market will look like, meaning, will you be able to refinance? Will that lender be out there that wants to refinance your loan? Will you have enough equity to refinance? So there's a lot of indicators, but you got to make the best choice for you and your family. So hopefully I didn't lose you through all that. If you did find some value in this video, what I'm going to ask you, please click that like right over there. Click that subscribe button right over here and that little bell icon right. That's it right there. And I'm going to put a video right up here and show, again, I appreciate you guys returning to the channel, and I'll keep you guys posted on any changes that we see over here. But other than that, have a fantastic weekend, and I'll talk to you guys next week. Bye.